Well, what we said was not that the real sector growth was not there. We simply said that the growth has come from primary production agriculture and from wholesale and retail trade and services, and we need to continue to promote growth in manufacturing. This is a continuation of what we said at the last communique in the previous MPC. The update on 150 billion naira was just an update on what has happened with the 200 billion naira fund that we put in place as part of 500 billion for refinancing manufacturing companies that have already borrowed from banks,
Right.
but are having difficulties servicing their loans because of interest rates and loan structure. So about 100, almost 150 companies have been identified, and as you said, yes, total is 150 billion, and within the course of this month, we'll disburse to the banks for restructuring.
Now, we see lending rates are still somewhat sticky, even though deposit rates have come down over the last quarter. Can you give us some of your views in terms of how we're going to improve on the risk profiling of customers such that lending rates would be lower?
Well, interest rates have generally come down at the top end. If you talk to the banks and if you talk to the customers, you'll find that the large multinational corporations, the large companies, Indian, Chinese, Nigerian, they tend to have low interest rates. I mean, you've got companies borrowing at single digit, and they're quite a number, and that's a substantial part of the credit portfolio in the banking industry. But the point made by the MPC is that these are not the job creating, poverty eradicating SMEs.
Right.
And therefore, if you give single digit interest rate to Shell or to MTN or to Dangote, that is really not the same as coming down to even 13, 14, 15% for the small SMEs in different parts of the country, because that is where it is needed.
Right.
So interest rates have come down at that level, not as deeply as we would like them to, which is natural. They're a bit sticky. There are risk factors. Some of the risk factors are institutional and infrastructural. We've got problems with credit bureau and credit information. We've got problems with repossession of property in the event of a default. We've got problems with a long and tortuous legal process in the event of a default by a customer. So part of what we're doing at the central bank level is to address some of those issues. So we're pushing through legislation for an alternative dispute resolution mechanism that would allow banks to realize their collateral in the event of a default. We're pushing through legislation on credit information that would allow credit bureau to have credit records and for the banks to have access to those records. I believe that the more banks get visibility on the credit history of a borrower, the more that banks get visibility on their exit strategy in the event of a default, then the lower the premium they're likely to add on for risk, because they can then see clearly that there is a recovery rate.
Okay, let's talk about the rescued banks. We know that there's some interest from local and foreign buyers for these banks. However, we have quite a number of banks to sell, and there's, in the unlikely event that we see some banks not getting bidders for them, what's the fallback plan for the central bank?
We've always had plans for every, since this process started, we've always had a plan A, a plan B, and a plan C. At the moment, for each of the banks, there are 2-3 parties that have expressed an interest in merging. Now, clearly, they will come in with bids after they finish their due diligence. We'll wait for the bids, and we'll see what conditions they've put in, and the boards will decide who their preferred partner is and who the reserve partner is. But there's also the other side. When we finish the analysis of the non-performing on the balance sheets, there's a question of the quantum of money that will be required to be injected by the AMC in order to move the bank into an M&A situation. And all of those will have to be looked at. So you've got a situation where, in my view, practically all of the banks should be resolved within a quarter.
Can you give us a little more clarity on how the CMC will actually work practically in terms of the operational aspects? There have been some comments about the AMC issuing bonds, and those bonds will be exchanged for toxic assets. Can you just give us...
Yeah, that's precisely how it will work. The AMC will trade in, will basically, its currency will be those bonds.
Right.
It will issue the bonds, 10-year bonds. They'll be guaranteed by the federal government, and they will therefore be acceptable as investments that carry zero risk rating, and perhaps to a very large extent also be eligible for repo at our window. So they're liquid instruments.
Right.
Now that is the instrument that will be issued in exchange for non-performing loans. It will also be the instrument that will be issued in exchange for primary for tier 1 or tier 2 capital in the need for recapitalization after taking care of NPLs. Because in some cases we might well find that after taking care of the non-performing loans, there's still a big hole, and the shareholders have to give shares to the MC and then take in exchange those bonds. So the MC becomes a shareholder, recapitalized institution in preparation for the M&A process. That's how it will work. The MC will also be a debt restructuring desk. So for the non-performing loans, there might be need for restructure, there might be need for a change in rates of interest, there might be a need for maybe a little additional working capital in managing the loan. So it will perform all those functions: debt restructuring, recapitalization, and non-performing loan.